Hello and welcome. This is Jim Forsythe, Chair of Citizens for Sound Money. I've got the privilege today of having Addison Quale today with us. He is with Monetary Metals. I first met him on Twitter and then went back and looked. He had an interview with Tom Woods, who I'm a big fan of, and read many of his books, and wanted to interview Addison. And first off, Addison, if you want to just give us a little bit of your background, especially any philosophical leanings towards sound money.
Yeah, so I I've always been a fan of the free market. I'm not really sure when that started. Maybe in high school, I heard the words laissez-faire and the idea of like just letting the market work and letting people work things out in buying and selling. It just rang really true to me. So I've always been free market oriented, and when I finally discovered gold and how it's like a money that you can't fake, it really rang true. And so I ended up working with Peter Schiff's gold and silver company called Schiff Gold. That was about almost 10 years ago. I worked there for a few years, and I now work with Monetary Metals, which is also doing something in the gold space, but basically looking towards gold in the monetary system and it being a sound money. It's always been something important to me, and in the area of the free market.
Great. You guys also deal with silver?
We do, yes.
Okay. And yeah, why don't you give us a big picture of what the company does?
Right. So Monetary Metals, the name comes from, so the two metals are gold and silver, the two monetary metals. Basically, we see sort of a pain point in the gold industry or in sort of the investment world where you can own gold and there's, strong reasons to own gold. It just adds value to a portfolio through diversification. But also it's a zero default asset. Gold can't default. You could have a treasury bond or $100 bill, but ultimately it's dependent on a counterparty to come through. But physical gold can't default. So anyways, the problem though is, where do you keep it, and how do you store it? And if you store it somewhere safe, you're going to pay to store it, and so you have a negative yield. And so ultimately, gold doesn't provide a yield. That's what Warren Buffett's been saying for years. Gold's not procreative. Monetary Metals saw that problem, and we thought, let's make it so that gold does pay a yield, and it's not a zero yielding, negative yielding asset. We want to make it so that you can own gold and earn a return on it, so that your ounces are growing over time and not slowly eroding away. And so that's really the main purpose of our company.
Yeah, that's great, and I totally agree that adding a yield to gold is key. And it used to be there back in the day. You deposit your gold in the bank, get a certificate. They could lend it out and produce a yield for you. And ever since going off the gold standard, that kind of thought has been gone. So it's good to see you guys bringing that back. So how do you users get a yield from what you guys do?
Right. So it's not rocket science. If you look at a bank takes deposits from savers and aggregates those deposits and turns around and makes a loan in the community to, say, a restaurant. And so they'll make a loan to the restaurant. The restaurant's paying 5% interest. Maybe the bank keeps 2% spread and then pays 3% to depositors. So Monetary Metals model is similar to that, except it's just in gold. We take deposits from owners of gold. We then set up a lease to a gold using business, like a jeweler, like a mint, like a bullion dealer, to help finance their operation. The mint is paying 5% interest. Monetary Metals keeps a 2% spread and pays 3% to depositors. All of this is in gold. So if it's like instead of a $2 million loan, it's like 1,000-ounce lease. And so the mint is leasing 1,000 physical ounces and then they're paying, let's say it's 5% interest, they're paying 50 ounces a year in physical gold back to monetary metals. We would keep a spread of 20 ounces, and then 30 ounces is going to the depositors. So that the yield generated, it's not a trade, it's not a financialization. The metal's still there physically, and it's financing productive business. And out of the surplus of that productive business's operation, that's where the yield is coming from and going to the investor.
Yeah. So how do you distinguish between a lease and a loan? Because I think you hinted at it that, the physical is still there when you're leasing your gold.
So in a lease, the analogy we like to use is like renting your car out. You can rent when you go on vacation, you rent a car at the airport, it's not your car. It belongs to the rental company. There's controls on it. You can't just do whatever you want with it. But it's physically present and still yours. So when you lease your gold out, the gold stays in physical form. It just changes form and location. So maybe you're starting with gold bars at the main vault, but when you lease to a jeweler, the metal is now in the form of jewelry at Brinks, New York. Or if you lease to a coin dealer, it's now in the form of gold eagles in Idaho. And you can even lease to like a mining company, or at least a refiner. It could start out as doré bars, and then it switched into the form of doré bars, and they're refining them into finished bars. But the common denominator is, in a lease, the lessee is taking a lower value gold product, doing something to it, making a high value gold product, and then selling it to their customer. And so the lease is isolating that value, helping them isolate that value in their business and not have to worry about the hedging. But yeah, going back to, so lease versus loan. Lease, the metal is physical, you still own it, it just changes form and location. A loan, and you can have insurance on it. So metal can still be insured in a lease. In a loan, it's very different. A typical borrower for a gold loan or a gold bond would be a mining company. So a gold mining company might raise 10,000 ounces of gold. We send them the 10,000 ounces of gold. Instead of just holding on to it, though, they're going to sell that for cash because they want to hire workers, they want to rent trucks, build a mill, and then start digging dig ore out of the ground and get that milled so that they can extract gold to then pay you back. So we would say that leases are more operational risk, and a loan or a bond is more credit risk, where the gold is gone, and it goes on the balance sheet. A lease, metal does not go on the balance sheet of the company. It's held off balance sheet because you're still the owner. But in a loan, it goes on their balance sheet, as a liability, and basically they are going to pay you back with gold that they extract out of the ground. So the gold's gone in the meantime. So bonds and loans would be higher risk. So they typically pay a higher interest rate.
And so let's say, for example, a jeweler that leases 1,000 ounces of gold, and they turn it into jewelry. So when they sell it, they don't have that gold. So is the idea that as soon as they sell it, they have to replace that gold?
Yes, that is absolutely correct. In fact, it's beforehand. They can't, in a lease, you're not allowed to sell the metal on lease. So you take a jeweler. A jeweler has, let's say, 1,000 ounce lease, and it's like, imagine it's in a display case. The customer comes up and says, I want that necklace. So instead of, and then take cash from the customer, instead of just taking out that necklace, handing it over, because then you'd be at $9.99. Right. So what they do instead is they'll take the cash, they'll buy an ounce of raw gold, or gold at spot or wholesale gold, and put that into the display case, and then take out the necklace the customer wants and hand it over to them. Gotcha. So in other words, you can't dip below 1,000 ounces. You can't dip below the level of the lease, mechanically.
And is that
so you have to have strict controls to make sure that doesn't happen.
And is that, you can't dip below the 1,000 ounces, in import inventory at your site? Does it count like if you've, ordered replacement gold? How's that work?
So every lease is set up a little bit differently. You could have, because yeah, you're right. The time that it would take for metal to, or new metal to come into that display case, there's a time lag. So maybe it's they're buying it from the wholesaler, and the moment it's on the FedEx truck, that can count as part of the lease. And
Great.
so then you can hand over the necklace to the customer.
Yeah, interesting. So
And
yeah,
so there's certain places where it can go, where the metal can flow and where it can be, and count as on lease. And then other places we said, no, that's not allowed. And so strict controls are a very important part of it. And so that's something that's very important as we set these up.
yeah, great. And so to be clear, that the person doing the leasing does not get the exact same gold back, but they get the same quantity, the same quality, or an equivalent.
That is correct. So our view is physical gold is fungible. So
Right.
you might start out sending in coins, or if you were an investor and you want to earn gold interest from us, you could either buy gold through us, and so you'd be buying gold pool, physically allocated 1-to-1. It's like kilo bar sitting in the vault, and that's typically $15 to $17 over spot. Or you send in coins or bars, and those can be brought in. Eventually, they would be converted to gold pool, and that would go into a lease. When it comes out, it's coming back as gold pool. But yeah, you don't really need the same exact bar that you sent in. Just as if I deposit $1,000 of cash in New York and then I go to Vegas, I don't get upset that the ATM over there didn't give me the same, $100 bill.
Gotcha. Yeah, so essentially, like if you're a manufacturer, let's say it takes a month to manufacture this stuff, but you can sell and replace, or it takes you a few days to replace the gold. This allows them to have an inventory where they can have a good
Exactly.
pipeline in the manufacturing process, yet only have to float enough cash or inventory to handle that 2-day turnaround of buying replacement gold.
Right. It's funny. So if you're like a jeweler, you don't really need to own your inventory.
Right.
You just need to be able to hand over a necklace in a timely manner to the customer. You just need to make use of it and have like variety. But
Yeah, and
so every lease is different, but then every lease is also, it follows the same pattern of, it's physical, it's taking a low value product of gold and finishing it to some degree. And yeah, and yeah, so you're adding value, but it's got to stay in a certain pipeline. It's allowed to be in just these certain areas.
yeah, it's interesting because I've gone through this myself a little bit, but as a believer that the dollar's going down, I'd love to borrow lots of dollars and buy gold and silver. But if you're operating a business, that's extremely risky because the gold and silver price moves down. Now you got a dollar denominated debt. Whereas in this case, if you're selling it some percentage over spot, you're marking it up 10%, you're paying 5% for a loan. As long as you sell that inventory within a year, you're in good shape.
Exactly.
You've made the spread and you don't carry any price risk. So very cool.
That's right.
And how about vaulting? Where do you guys do your vaulting?
So our flagship vault is the Delaware Depository, which is owned by Fidelitrade. We do have a network of vaults around the world, a number of Brinks vaults. So that would include Toronto, I think both Vegas and Los Angeles, Singapore. We also have Zurich and ABC Bullion in Australia.
Gotcha. And so you talked about some of these deals like 1,000 ounces of gold. As someone that is holding with you guys, do they have to hold in that size, or can they have a smaller quantity yet still get part of one of these deals by, say, aggregating the users?
That's correct. So the minimum account is 10 ounces. So you could come on board with as little as 10 ounces of gold. That's about $18,000, or 800 ounces of silver. And the deals are made up of many investors come on board. Typically the deal is oversubscribed. So when you offer on a deal, you generally don't get all that you're offering because other investors are trying to get in. But we have a good flow of deals. So eventually all your metal gets into deals. And we did, I think, about 7 to 8 deals in the last 8 months. The flow of deals is increasing as we scale up. So I've seen many investors come on board with many ounces, and eventually they've got them all allocated and they're wanting to add more so that they can earn interest on more ounces.
So 10 ounces of gold, 800 ounces of silver. Do you do many silver deals too, or is it primarily gold?
We do silver deals. There tend to be more gold deals than silver deals. But we will have other, we do both. And as the silver deals come, we bring them out to the market.
And what's the kind of market like for lease rates? Like what are the things that impact the lease rates?
So the lease rate right now, the range is 2 to 3%. So that would mean that the lessee is paying like 4 to 5%, because our fee is 2%. So Monetary Metals makes a 2% spread. I think the main factor is the alternative financing option that lessees have.
Gotcha.
And it's relatively stable.
Gotcha. So where do people find out more about your company? And is there any last things you'd like to say? I think we covered things pretty well, unless I missed something.
No, I think we've covered it well. Basically, you can find us at monetary-metals.com. So that it's monetary-metals.com. We're looking forward to our next opportunity. In probably February or March will be our next deal. So basically you can set up an account, fund it with ounces, and then participate. I guess one of the last things I'd say is, we are hoping to make a difference in the monetary system. It's our feeling that the monetary system is not doing great. There's issues, and I think they stem from gold not being as a part of the monetary system. By providing interest on gold and financing in gold, in a way, we're kind of jump starting, gold acting as real money again. And if we can get this going and make interest on gold a thing and make it sort of go viral, we can maybe put a dent in some of the issues in the monetary system and really make a big difference. We like to compare ourselves to, or we would like to have our story be similar to Uber, and how Uber kind of came out of nowhere and took on the New York City taxi cabs. They didn't bring Uber in by legislation. They just kind of acted, and it went viral. We would like to do that, and I think that's kind of the way forward for gold to come back in the monetary system. Is not going legislatively and talking to the folks in DC, but let's just be entrepreneurs. Let's build out a business and have something go viral. And once it's out, it's going to be hard to bottle up.
You took the words out of my mouth. That's exactly what Citizens for Sound Money all about. Is not about trying to legislate and make the dollar backed by gold again. It's getting people to go out and start using sound money. And I think the ability to lease and earn a yield on that is absolutely vital, because you look at the correlation between treasury bond yields versus gold and silver, and it's this long historical trend. But if you can attach a yield to gold and silver, that is absolutely the key to bringing it back as money, or one of the keys, I think.
Yes. Yeah, we agree.
All right. Well, I definitely appreciate your time. Thank you.
Yeah. Thanks so much, Jim. It's been a pleasure.